Ever wonder how you can secure your financial future in today's unpredictable market? Well, the answer lies in setting clear, achievable financial goals and understanding the importance of building wealth in an ever-changing market landscape. Think of your financial goals as the compass guiding your investment journey. They not only give you a sense of direction, but also provide a benchmark to measure your progress. Whether you're saving for a house, planning for your retirement, or simply wanting to increase your net worth, setting financial goals is a crucial first step. But setting goals isn't enough. You need a deep understanding of market trends to navigate the choppy waters of today's financial seas. It's about planning strategically, forecasting potential challenges, and making informed decisions. Remember, the market today is like a puzzle with constantly shifting pieces, but with the right goals and a keen understanding of the market, you can put those pieces together. Setting your financial goals is the first step to building wealth. Now let's explore how to achieve these goals. Understanding the market is crucial. It helps you make informed decisions and mitigate risks. Picture the market as a giant machine with countless moving parts, each influencing the other in ways both subtle and dramatic. It's a system that's constantly evolving, responding to myriad factors from government policy to technological advancements, and even cultural shifts. Understanding this system can seem daunting, but it's not an insurmountable task. It starts with recognizing the importance of market trends. These are patterns or tendencies in specific sectors of the market. For instance, if there's a surge in electric vehicle sales, it can indicate a growing trend towards sustainable transportation. Identifying these trends early can provide you with valuable insights on where to invest and what sectors to avoid. Next, we have economic indicators. These include things like interest rates, inflation rates, and gross domestic product or GDP. These elements provide a snapshot of the economy's health. For instance, high inflation rates may suggest an overheated economy, possibly leading to a future recession. On the other hand, low interest rates often encourage borrowing and can stimulate economic growth. By keeping an eye on these indicators, you can get a sense of the market's direction and adjust your strategies accordingly. But understanding the market isn't just about trends and indicators, it's also about staying updated with financial news. This doesn't mean you need to become a Wall Street Journal addict, but regular check-ins on major financial news outlets can help you stay informed. Remember, the market can be influenced by a wide range of events, from corporate earnings reports to geopolitical tensions. By staying informed, you can react swiftly to these events and adjust your investment strategy as needed. In a nutshell, understanding the market is about more than just reading charts and graphs. It's about understanding the world around you, the forces that shape our economy, and how these elements can impact your financial journey. It's about making sense of the complexities and using this knowledge to navigate the financial seas with confidence and foresight. Understanding the market is like having a roadmap to your financial journey. It guides you towards your financial goals. Ever heard of the saying, "Don't put all your eggs in one basket"? This is the essence of diversification. Now, what does diversification mean in the context of building wealth? Simply put, it's about spreading your investments across a variety of assets to reduce risks and potentially increase returns. Think of it as a safety net. If one asset performs poorly, others might perform well and offset the loss. Imagine you're a farmer. If you only grow one type of crop and a disease wipes it out, you lose everything. But if you grow a variety of crops, the disease might only affect one type, leaving the others unharmed. Your overall loss is reduced and you might still have a successful harvest overall. That's diversification in a nutshell. In the world of finance, these crops are different asset classes such as stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics. Stocks, for example, might be more volatile but offer higher potential returns. Bonds, on the other hand, might provide lower returns but are generally more stable. By investing in a mix of these asset classes, you can balance risk and return according to your financial goals and risk tolerance. It's important to note that diversification isn't about chasing the next big thing or trying to predict which asset will perform best. It's about building a well-rounded portfolio that can withstand market fluctuations and deliver steady growth over time. Moreover, diversification isn't a one-and-done deal. It requires ongoing attention and adjustment. As market conditions change, so too should your portfolio. This doesn't mean you need to constantly buy and sell assets. Instead, it's about regularly reviewing your portfolio and making necessary adjustments to maintain a balanced asset mix. In conclusion, diversification isn't just about protecting against losses. It's about optimizing returns by investing in a broad range of assets. It's a key strategy for building wealth, enabling you to weather the ups and downs of the market. And remember, diversification isn't about avoiding risk altogether. It's about managing it intelligently to achieve your financial goals. Diversification is a key strategy for building wealth, enabling you to weather the ups and downs of the market. Scene script: regular investments and compound interest, two powerful tools in your wealth-building arsenal. Let's start with regular investments. Imagine you're planting a garden. If you sow seeds consistently over time, you'll have a thriving garden. The same principle applies to your money. Regular investments, however small, can lead to significant growth over time. It's not about dumping a large sum of money into an account and hoping for the best. It's about sowing financial seeds consistently, nurturing them, and watching them grow. So how does this work? Well, investing regularly harnesses the power of something called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. Over time, this can lower the average cost per share of your investments. Now, let's move on to the magic of compound interest. Compound interest is interest on interest. It's where you earn interest not just on your original investments, but also on any interest, dividends, and capital gains that accumulate. So your money can grow faster and faster as time goes on. Albert Einstein once referred to compound interest as the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Imagine this. If you invest $100 per month at an interest rate of 5%, in 20 years, you'll have invested $24,000. But thanks to compound interest, your investment would be worth over $40,000. Compound interest helps accelerate your wealth accumulation. It's like a snowball rolling downhill, gathering more snow and gaining speed as it goes. The longer you leave your money invested, the more time it has to roll downhill and gather more interest. Regular investments and compound interest are your allies in the journey of wealth building. They work silently but surely. Financial discipline, the foundation of any successful wealth building strategy. It's the bedrock upon which all other strategies rest, the compass that guides every financial decision. And why is that? Because without financial discipline, even the most brilliant investment strategies can crumble like a house of cards. Financial discipline is essentially about three key things: maintaining a budget, controlling expenses, and making regular investments. These are not just financial terms, but tools that can help shape your financial landscape. Picture this: you're on a journey, a financial journey. The budget is your map. It gives you a clear view of where your money is going, helping you allocate resources effectively and plan for the future. A well-structured budget can be the difference between sailing smoothly towards your financial goals or drifting aimlessly in a sea of uncertainty. But a map is only as good as the traveler's ability to control their journey. This is where expense control comes in. It's about making conscious decisions to ensure your outflow doesn't exceed your income. It's about distinguishing between wants and needs, and making sacrifices where necessary, not because you're forced to, but because you're driven by a greater goal: financial freedom. Now let's talk about the third pillar: regular investments. This is the engine that propels you towards your financial goals. Regular investments, whether in the stock market or a retirement fund, allow you to harness the power of compound interest, turning small, consistent contributions into a mountain of wealth over time. But remember, financial discipline isn't about deprivation. It's not about saying no to every little pleasure life offers. It's about balance, about making informed decisions today that will pave the way for a secure tomorrow. It's about giving yourself the freedom to dream big and the tools to make those dreams a reality. So let's not see financial discipline as a constraint, but rather as a stepping stone to financial success. After all, financial discipline is not about restricting yourself. It's about empowering yourself to build a secure financial future. Building wealth is not a sprint, it's a marathon. It requires planning, understanding, and discipline. With that said, let's take a moment to recap the strategies we've discussed today. We started by emphasizing the importance of setting financial goals. It's your roadmap to wealth, your beacon in the financial storm. Next, we dove into the need to understand the market. Knowledge is power, and in the world of finance, that statement holds more weight than gold. We then moved on to discuss diversification. Remember, don't put all your eggs in one basket. We tackled the concept of regular investments and the magical power of compound interest. It's not about the amount you invest, but the consistency of your investments that matters. Then, we touched on the cornerstone of wealth building: financial discipline. Remember, the journey to wealth building starts with a single step. Make that step today, and secure your financial future.